Asset valuation methods are essential tools used to determine the economic value of various assets, serving purposes such as financial reporting, investment analysis, and decision-making in mergers and acquisitions. The choice of method depends on the asset's nature, the intent behind the valuation, and the availability of relevant data. Among the most widely used approaches is the cost method, which bases an asset's value on its original purchase or construction cost, accounting for depreciation or amortization over time. This method is particularly suited to tangible assets like property, plant, and equipment, where historical cost information is readily available. Another commonly employed approach is the market method, also known as the market comparison or sales comparison method. This technique estimates value by comparing the asset in question to similar assets that have been sold recently under comparable conditions. It is especially prevalent in real estate and securities markets, where there is sufficient transactional data to establish reliable benchmarks. In contrast, the income method focuses on the asset's ability to generate future earnings. By discounting projected income streams, using models such as discounted cash flow, DCF analysis, or capitalization of earnings, this method is often applied to income-generating assets like businesses or rental properties. For valuing entire companies or investment funds, the net asset value (NAV) approach is frequently used. NAV calculates value by subtracting total liabilities from total assets, providing a clear snapshot of a company's net worth at a specific moment. The replacement cost method, meanwhile, estimates what it would cost to replace an existing asset with a new one of similar kind and quality, adjusting for factors like depreciation and obsolescence. This approach is useful when assessing assets that may need to be replaced due to wear, technological advancement, or other factors. Finally, the liquidation value method assesses the price an asset might fetch if it had to be sold quickly, typically in a distressed or forced sale scenario. As such, liquidation value is generally lower than fair market value, reflecting the urgency and potential lack of buyers in such situations. In practice, valuers often use a combination of these methods to arrive at a more comprehensive and reliable estimate, ensuring that the chosen approach aligns with both the characteristics of the asset and the purpose of the valuation.